Hello and welcome to our final LinkedIn Live event of the year. Thanks for tuning in to our various webinars this year. There will be many more in 2024, but today is the last one as we head into the Christmas break. Just a few more days for me. And today it's time to recap 2023 and think about the year ahead for financial markets. Whilst we'll cover some major topics and themes in this conversation, I want to reiterate the entire point is to demonstrate the uncertainty, the known and unknown unknowns in markets. And I think we'll find that out as we go along through the call. To help us do just that, I'm joined by two special guests. That's one down from the three advertised due to a last-minute scheduling issue. David Bell of Think Money sends his very sincere apologies. So joining me today from London, we have cross-asset market analyst at Pepperstone and Oku Markets' very own weekly columnist, Michael Brown. As I said before, we are just overjoyed to bring you an interesting chart and topic each week from Michael's thoughts. So please do subscribe to the newsletter and watch and read his wonderful content over at Pepperstone. And alongside Mike, also in London, you may recognize him from his now infamous and very useful daily market update videos from his unicycle. It's FX Plu from CurrencyTransfer. And finally, I'm your host, Harry Mills, director at Oku Markets, a London-based currency management firm servicing SMEs, multinationals, and private clients. Welcome, gents. Thanks very much for being here. Mike, good to see you again. Hello, FX Plu. How are we doing today?
Mate.
Good afternoon.
Good stuff.
Yeah, very well, thanks.
Good to hear. Good to hear. Now, we promised a market outlook that would be fun and informative, so I think we've got a good group on. We've got a decent agenda for this discussion as well. We'll start out with some 2023 talking points, then we'll switch to the UK for a bit of an outlook on 2024. We'll tackle some of the big questions in markets, and then we'll put our forecasting caps on and we'll make some predictions for the year ahead with some outlandish calls, I hope. So why don't we kick things off, Michael? We'll turn to you for your major market memory of Michael Brown for 2023. Go ahead, over to you.
Yeah, well, I'm sure we can cover off the fun this afternoon. I'll leave the informative bit of that to the judgment of our viewers. I guess the biggest thing that stands out over the last 12 months when I look back is, and taking a cross-asset view, not just in foreign exchange, is this idea of the Magnificent Seven, which is a moniker that I'm not a particular fan of, but the headline writers seem to have determined that that's what we need to call Apple, Amazon, Google, Meta, Microsoft, Nvidia, and Tesla. And their performance this year has been nothing short of stunning. I mean, that basket is up 70 or 80% over the last 12 months. And more importantly than that, the gains that we've seen in equities, obviously primarily on Wall Street, the S&P up around 20% on the year, would not have been possible in the slightest without the gains that we've seen in those stocks. And I think it speaks not only to obviously the frenzy that's going on around artificial intelligence at the moment, but also it speaks to how technology is taking on almost by the day an increasingly greater role in our lives. And of course, as it does so, those tech behemoths get bigger and bigger and bigger. And I think that really, for me, stands out as the big idea over the last 12 months that, it really has just been all about those seven stocks.
Wonderful. I mean, I did take a look at US stocks before this call and noted that despite a pretty gloomy October time, everything's in the green. So that's the contribution, 70 or 80% from those Magnificent Seven stocks, yeah?
Absolutely. And actually, just on that, yesterday was the first day since July of last year that the S&P 500 has ended the day in the green, ended the day higher, but none of those seven stocks have done so. So we're talking 18 months since the index actually rallied without those stocks participating in the move, which is, just nothing short of remarkable.
So green shoots for 2024. FX Plu, what about you? What was your major market memory of this year just gone?
So I think for me, like the main takeaway has been that the Fed's broadly got it right, but the detail in that in particular that stands out for me has been the control that they put on the bank failures and the lack of contagion. Genuinely, when the US banks started to go under, the regional banks and indeed Credit Suisse, I thought, here we go again. this is going to tie up the commentary for months because it's going to go and go and go. But no, they managed to stabilize the ship, put enough confidence into the market to prevent a run on the banks, and I think that's a good pat on the back deserved to Powell and his colleagues, because that could have been 2008 all over again.
Yeah, it could have been, and indeed I was in a similar position to you, writing daily notes, talking to customers about those regional bank failures, and within a matter of weeks it was a non-story again. And Mike, anything to add on that point?
No, because I want to cover that actually in our next segment. So I'm gonna save and not peak too soon.
Keep your powder dry. Okay, so I mean, mine is also related to the Fed. So mine is the cyclicality of the dollar, and the Fed's actions and the Fed's words. So any regular readers of my newsletters will know that I'm no fan of central banker speeches. I actually wish they'd all just shut up in between their meetings, to be quite honest.
Don't we all?
Don't we all? Yeah. But, from the peak in the dollar index last September, the dollar's about 9.5% lower, give or take, at the moment. But it's been as much as 13% lower. And there's been 7 points on the chart for the DXY, the dollar index, that represent a turning point. Now, I did measure this. I'm not going to bring it on the screen, but I did measure it. 82 down days, 35 up days, 64 down days, 15 up days, 42 down days, 82 up days, 29 sideways, that was October, and then 28 down days. So it's been like this. It's been a slow, and each one of these turning points shows us a Fed action or an inflation data point that's been released. So that's going to be my major market memory, is how they've controlled and they've moved the markets, whether it's stocks or whether it's the dollar itself. There we are. So those are the major memories.
Well, I didn't realize you wanted us to come back on that one. I think it's a very good point. I think it's also, it just speaks to, perhaps I would argue, actually the low vol that we've seen in foreign exchange over the last, basically calendar year. I read, and I'm not doing this just to get brownie points, but my boss pointed it out to me, Chris Weston. Euro dollar is on track for its second tightest annual trading range ever. So some would say, yeah, it's cyclicality. Maybe you could even just say, actually, it's a market that doesn't really know what to do with itself.
Second tightest trading range ever. Yeah, it's been,
yeah,
there
second tightest annual range ever.
Incredible, low volatility.
But I think that's also that also points to the forward guidance that we're getting. This year, everybody has known what the central banks are going to be doing way ahead of time. There have been no shocks. I mean, maybe when the Fed paused for the first time, it caught some of the markets slightly off guard. But genuinely, it seems that the market hasn't been surprised throughout the year. And as a result, that's demonstrated in the volatility or the lack of volatility in the market, presenting a pretty much business as usual trading conditions.
Yeah, very much so.
Good point. Good point. Well made. So those are the three big memories that stick in our minds. What about the most under-mentioned important theme? And let's stick with you, FX Plu. What's yours? I think you might have a nice one up your sleeve for this.
Play to the crowd here. I'm going with Brexit, just to really stir the pot, because it's not really been in the headlines. Granted, there have been a few other things, monopolizing the political headlines, but at the same time, this is something that has an ongoing effect. And I think it will probably play in a lot more next year when things get a little bit more political ahead of the election. But I think the UK economy is carrying a significant hangover in the performance that is being demonstrated from the effects of Brexit. And again, I don't want to get involved in whether or not it was good or bad. I'm politically neutral in these situations, deliberately so. But I do like to point at things like Brexit just to, provide that commentary and hopefully stir up the emotion of the audience slightly. But yeah, that for me is something that I think has dropped off the airwaves more than it should have done. And I get it, like everybody is sick to the back teeth of Brexit so many years later. But, again, even last week, I can't remember who it was. It might have been von der Leyen noising up for the headlines going, oh, yeah, well, the UK's positioning itself to rejoin. And it's like, okay, well, if that's what you reckon over on the continent, good luck to you. But again, I do kind of miss it because it is so divisive and so monochrome in one's opinions. But hopefully we'll see a little bit more of that come back next year.
I think we might do. There's been enough politic activity, right, in this country to get us through without bringing up the Brexit piece. And I see Mike was shaking his head. He's clearly got something to say. But before you do so, I'll squeeze in mine because it's kind of linked, FX Plus. So, we could have looked at banking failures. Remember those Chinese balloons that burst? China in general, faltering Germany, Credit Suisse. For me, it's and hopefully for the audience, the most undermentioned but important theme was Britain's better post-Brexit, post-COVID recovery, and the recession that never really came. And this was quite underreported. It was early September, I think. The ONS quietly revised higher its UK GDP numbers and was showing that the UK was 1.8% above pre-pandemic levels in the 3 months to June of this year, beating both France and Germany. And there was a wonderful article in The Spectator at the time, which I shared through my channels, but I think it's been generally underreported. Things aren't as bad as whoever they are, said they might be or were. And we're seeing a lot of these revisions, aren't we? So, Mike, I'm sure you want to jump in there on revisions and on Brexit. So that's my theme that's been underreported anyway.
Well, this is like, how much kryptonite can you give Mike Brown this afternoon, isn't it? We've gone with Brexit. We're now going with revisions to GDP. I've already seen the next question. I won't spoil it, but I think my head might explode. I must admit, I did wake up this morning on the train in, reading about all these factions over the Rwanda vote. I was thinking, are we in 2019 all over again, just with a different topic? Because it feels like nothing has changed in some respects. I think the GDP point is a good one. It's just always the way with financial journalism. The initial story, that shock value, that bad news sells, and funnily enough, they never write quite as many column inches with the corrections when that bad news is revised away. But I guess that's always the way it has been, and probably always the way it will be. We call this an undermentioned theme. I think that might be a misnomer now because we've already mentioned it twice in the space of 15 minutes. But it is actually those regional banking failures that we had in the United States back in March. I think undermentioned because the whole thing was almost over as soon as it began, within 2 or 3 weeks. I'm setting Credit Suisse aside from this because they were a special case, maybe even a basket case for quite some time. But I think it speaks to what Paul was saying earlier around the speed and the efficiency with which the Fed stepped in to backstop the market and provide the liquidity that was needed and prevent any contagion into the broader financial sector. I think we have to take our hats off to Powell and co for doing that. But more broadly, and I think this may become important as we go into 2024, it was the ability for a central bank to split up its sort of two functions, one of which being monetary policy and the second being financial stability. Because what the Fed were able to do was say, we still need to raise rates, we still need to get inflation under control, but we're going to do that while ensuring that banks have the liquidity they need and ensuring that, if you like, a financial accident doesn't take place and we don't make things worse than they already are. And I think that laid out a bit of a blueprint, and we obviously saw that with the BOE at the tail end of 2022 with the gilt market issues when Liz Truss was Prime Minister. So we've got a couple of examples now of actually how central banks can continue to tighten policy but actually ensure that where liquidity needs to get to, those targeted injections can take place. So I guess the lack of anything going drastically wrong, despite the most aggressive hiking cycle in 4 or 5 decades, is probably something that people haven't paid enough attention to and actually haven't given central bankers enough credit for.
That's a really good point, and how to utilize both of the points of their dual mandate. price stability, as you mentioned, alongside monetary policy. So still tightening policy at the same time is really something that's probably, as FX Plus said earlier in the call, why it was a 2 or 3 week story and not something that lasted on and on and on and on, and we were all getting bored of, and it was major market meltdown. What about you, FX Plus? Any thoughts on those points?
Well, yeah, I mean, I think, again, the fact that it went away so quickly was a testament to the solution being there. But as Mike said earlier, good news doesn't sell financial, financial publications. Yeah. When it was potentially an uncertainty and potentially bad news, it was everywhere. But as soon as the solution was rolled out, and it's almost like, the market recognized, oh yeah, that's going to work. Oh, cool, well done. Then, there aren't any any journalists rolling out the plaudits for power. It's like, yeah, but what's the next thing, the next challenge? Where may you get something wrong? And that's very much the focus. I think the life of a central banker is damned if you do and damned if you don't. And you're going to come into an awful lot more scrutiny in the tough times, and the successes and the good points that you do roll out as a team just get accepted as, well done, that's your job, now move on.
That's what you're paid handsomely for.
Thankless task.
It's a thankless. And speaking of it being a thankless task, let's move on to the third question of this introductory part, which is, and I'll let you two tell me whether you want me to go first on this or not, so you can then rip me a new one. What do we think about Andrew Bailey?
Well, given that there is an Andrew Bailey fan club and it's only got one member in it, and that member is on the call and in fact chairing the call, I think it would be rude if we did anything other than let him go first.
Okay, fine. So I will go first, although I haven't had a selfie with him, Mike, which I think he might have done. Look, I see Bailey as a straight talker most of the time, someone who doesn't like to sugarcoat or gloss over the situation, the economic situation the UK has found itself over the past year. Don't forget the BOE, the MPC was one of the first central banks to raise rates, before the Fed and before the ECB. And I think they did it quite measured and in quite a sustained way, and with not letting the horse bolt too quickly. And I think that's important because I think that the UK, the people in the UK, we've got a different attitude to these sorts of things, and I'm not sure we could take 75 basis point rate hikes like we saw in the Fed, from the Fed, pardon me. So yes, there's been a few gaffes. There's been a few interesting things said about wages and basically instructing Joe Public not to ask for pay rises when the man is himself paid something insane amount of money. But I think they've done a broadly good job. I have a whole page full of quotes, which I'm not going to read out. It took me ages to read every time I've quoted him in all of my newsletters this year, but I think they've done a pretty good job against a pretty awful backdrop. I'm now going to zip up and just tin that on.
Mike, do you want to dive in with the opposite view?
Because go on then. I was going to say, I think it's important to recognise that the BOE in general and specifically Andrew Bailey have been dealt a very, very bad hand. We've got inflation at its highest level since the 90s, and sticky inflation, which importantly other economies are not necessarily dealing with. We've also got pretty much no economic growth. Growth is very, very anemic indeed. And obviously we've got ongoing issues in the housing and the mortgage market, which is meaning that the effects of the BOE's policy actions are taking a lot longer to hit the economy than you're seeing elsewhere. Having said all of that, I think they've played that bad hand very, very poorly. You're right, the BOE were the first to raise rates among all G10 central banks all the way back in December of 2021. So to be in that position, but for us to still have the highest inflation rate of all G10 economies suggests that something has gone pretty dramatically wrong. I think it's also important to note actually that Bailey has not at all been helped by his colleagues. Bailey himself saying don't ask for a pay rise. Hugh Pill at one point was telling everyone that they just need to accept being poorer. He also had a bit of a slip up the other day on the other side, saying that actually they may cut as soon as the spring. I think generally About 100 yards down there is Threadneedle Street, the Bank of England. I think it's been a bit of a shambles for the last 18 months or so. They used to be one of the most credible G10 central banks out there. I think they have almost entirely blown their credibility at this point in the way that they've just been utterly ineffective at getting inflation under control and losing that first mover advantage. And I think that is it is a sad situation to be in, but unfortunately that's the situation that the bank and sadly the UK economy ends up finding itself in.
Well,
so
it's tricky to argue with those points, isn't it?
Yeah,
but FX, where do you sit?
Points. But well, again, I do naturally adopt a politically neutral standpoint on this, and rather than attack the individual or indeed the results, which you two seem to have done a pretty good job of both supporting and criticizing. For me, the point is it's a very, very difficult position that subpar talent is put in. Right, Mike, you mentioned that before Bailey, we had the world-class credibility across the G10. Yeah, cool. Carney had a great reputation. He also had a bloody easy job managing ultra-low monetary policy for his, under his stewardship, and he jumped ship just when things got fruity. So I don't know whether that was luck or judgment, but well played to him. He goes with his reputation intact and a wonderful career ahead of him. The point that I'm making, though, is the position, regardless of who is in it, is massively underpaid for the talent available. Any half-decent economist is hauled up in the back offices of, one or other investment bank, tied to his desk, making the millions from reading the markets, reading the data, and outputting accordingly. And I just don't think there's the available talent in the public sector to drive a policy that works well enough. And again, fair enough, you can't please all the people all the time, but certainly in these unprecedented, challenging times, it's a tough job. Yes, Mike, I think you're absolutely cock on with the suggestion that we've blown the first mover advantage. And yes, Harry, I think you're probably right saying that is the UK really going to accept a 75 basis point move? Who cares? If they think it's the right thing to do, since they were granted independence, they should bloody well do it. And they should do it with the comfort and the confidence of all of the data analysis that goes into running a bloody country, which frankly should have more budget behind it than Goldman Sachs or JP Morgan, for example. But the reality is that they don't. And whilst he does have a horrifically high salary for the quality of his output, which obviously has been bought into the crosshairs given the insensitivity of some of his comments. But I just don't think we can fairly judge a central bank team when they've got primary school budget attached to it compared to the other roles that are available in the private sector.
On the street, in the city, and at Bloomberg Economics, for example. So we've got sack him, we've got pay them more, and we've got pat them on the back. Let's leave Andrew Bailey there with his mixed reviews, and let's switch to it was very impassioned, FX, but I must say, let's switch to the UK for an outlook. And I'll start by saying, I hate to say it, but I see next year, I see 2024 as a year of indecision and stagnation. Despite my earlier comments about the ONS revising higher GDP, growth is fairly stagnant at the moment. And we've got a public that's been beaten and whipped by inflation and high interest rates. People are a bit fed up. They're not spending. Consumer confidence is, albeit restoring, it's still in the red. Retail sales are basically flat. People aren't spending money. And the services sector has just experienced 3 months of contraction. So couple that with a one-year low in business confidence, government debt nearing to 100% of GDP. It's at 97.1, I think, something like that. Yes, interest rates will come down next year. Yes, inflation continues to ease, but is still sticky. I think unemployment's going to tick higher. I think most people in business, let's not forget, it's the backbone of the UK economy is SMEs. I think it's going to be time to batten down the hatches and await the election results. That's my personal view on next year. Indecision, stagnation. Mike, where are you?
Well, this is very easy. I mean, I pretty much agree with everything you just said. Sadly, not sadly, I agree. Sadly, because it's not a particularly rosy outlook for the UK economy. But yeah, there really isn't a lot out there in terms of good news at the moment. As you said, growth has been pretty much non-existent, not just this year, but really much of last year as well. The leading indicators that you look at, the confidence and sentiment surveys you alluded to, they're all pretty glum. And even if we were to get some policy easing from the BOE next year, which I think will probably come towards the back end of the year and be one of the last G10 central banks to ease rates, given the stickiness of inflation and the continued tightness in the labour market. I mean, earnings still growing at nigh on 7%, according to the data that we had out this morning. You've got to remember that the biggest impact of rates is on mortgages, and everyone's just locked in 2 or 5 year fixes north of 5%. So even if the BOE was starting to cut, you've still got that impact of tightening baked in for the next couple of years at least. So yeah, I think it's going to be a pretty dismal year next year for the UK economy. And of course, the uncertainty caused by the election, we don't know when that will be. It may be spring, it may be autumn, but that's likely to see business investment reined in again.
Yeah, I mean, it doesn't sound great, does it? I'm just hoping that the Bank of England start to reduce rates significantly before my rent is renegotiated in July of next year, because I don't really want another 13% rise. FX Clue, where are you? And hopefully you're not about to just roll over your mortgage into north of 5%. Where are you on this?
I am actually. I'm one of those guys. Yeah. But like I don't think next year is going to be anything to write home about. I think it's going to be really low, slow growth, flat, maybe negative. I think we'll be skirting along that line of zero or slightly negative growth. While basically they just do everything they can to avoid tipping into recession, which again questions the independence of the central bank, because I think that's more of a concern for the government going into the election year than the central bank. And I mean, funnily enough, I was having this discussion on LinkedIn earlier, back end of last week, I think it was, around the aggression or lack of aggression with the policy over the last 12 months or so, because arguably, if they had gone harder earlier, then who knows where we would be right now, right? We may have got to the point of pausing just earlier in the cycle, so we could be further ahead with the peak or the pause, status that we're in now by now. But equally, we could have gone too far too fast and been in a recession and found that harder to navigate out of. So, it goes back to the earlier point that central bankers are damned if they do, damned if they don't. But I do think that next year is going to be challenging. There's still a significant amount of mortgage borrowing that is still, case in point myself, that is still insulated from all the rate hikes.
Sorry, Paul, I was going to say 4 or 5 million, I think the BOE was saying last week, still to roll over.
Exactly, and that will come in the next, I guess, 12 to 24 months, and all of that effect of higher costs, personal budget squeezing as a result, less money to spend, so retail sales, consumer confidence, all of those touch points that ultimately drive the economy or not are still to see an effect, because of the key difference, I think, this time around is that a disproportionate number of these big borrowings, obviously the mortgage is the biggest borrowing that most households take, are locked in to longer dated contracts now. Whereas, in years gone by, that's been a much lesser extent in years of crisis and recovery, I mean. And so, yeah, I think we are still filtering that through. I think the Bank of England needs to be aware of that in their rate decisions, because there is obviously a risk of the full effect not having been felt yet. And while the back of fag packet suggestion is it takes about 3 months to be felt. It's like, well, it could be 5 years and 3 months to be fully felt, but let's not split hairs over that one. So yeah, I think there will be a lot of stagnation next year. I think it will be a really unimpressive year, and frankly, if you're trying to lead the country, it'll be a dreadful year to go to the polls.
And does that tie in nicely with your biggest economic concern for next year? I think you were thinking along the mortgage lines, weren't you? Squeezed incomes.
Yeah, absolutely. I think we've still got an awful lot to be squeezed out of that mortgage borrowing story. And again, that's one of the others that I thought would be a much more prevalent story, or would have a much more immediate effect than it actually has. And again, largely it's kind of gone away in the financial press because the fear of it, I think, is very different from the reality, which is, rates have gone up by X%. It's like, cool story. I'm locked into 5 years. Come back to me when it matters.
Yeah. April 2024. Yeah, or whenever it is. Yeah.
And that's now getting painfully close for more and more people. But again, to be fair, the story's broken, the story's passed, and it's like, oh, you now catching up. Oh, bless you. Yeah. Well, my mate John's been here for 5 years, mate. So that story's passed. But the net effect is absolutely going to continue trickling in across the next 12 to 24 months, I would expect.
So we've not felt the pain yet, but it is to come, and it's especially to come for 4 to 5 million more people. Mike, what do you think? What's your biggest economic concern? And maybe add a bit of colour to what FX Blue just said about those 4 or 5 million people or mortgages.
Yeah, so I mean, the mortgage one is obviously a big concern. I think it's also interesting how that one has actually faded a little bit. We were all talking about that earlier in the year, and now no one seems to be doing so. Although we're barely 50% of the way through of the wave of refinancing that needs to take place. So I think that's definitely still going to be a big story and a big theme into next year. I guess my bigger worry is that we see what you could almost call the last mile of getting inflation back to target actually proves to be the toughest bit of that journey, to use a very, very corny analogy. I apologize for that. But I think if you look at the underlying dynamics of what's going on in terms of inflation in the UK economy, everyone was popping the champagne because headline CPI came back below 5% in October. That was pretty much all because of energy prices. Not only did the price cap come lower, but there's also a massive base effect comparison with where they were this time last year. So I think we need to ignore that. Core inflation, when you take energy and food out, is still near 6%.
Yep.
Services inflation is somewhere near 7%, and earnings growth is somewhere near 8%, using very, very round numbers. And I think with that combination, unless we start to see a real move lower in all three of those gauges in the relatively near future, then you do run the risk of inflation becoming a lot more embedded and a lot more stubborn and more difficult to get rid of out of the UK economy. And I don't think the BOE are going to raise rates again, but it just raises the risk that the BOE do stay higher for longer. And we're looking at 5.25% bank rate for perhaps most of next year rather than just half of next year. And the knock-on headwind that will pose to economic growth, I would imagine that's going to be quite a stiff one. So the risk of inflation not going away anywhere near as quickly as we would hope, or anywhere near as quickly as other developed markets, I think that's the big concern I have for the UK going into next year.
So stuff getting more expensive, and you mentioned the services inflation. I wasn't aware of that number myself. That sounds like an input problem as well. Maybe also with the wages, that's a post-Brexit issue when we've got too few people chasing jobs, and that pushes up wages. My biggest economic concern is the working population. We've got 5.5 million people on out-of-work benefits, 2.6 million on long-term sick. Taxes are at a post-Second World War high, and with record net migration to the UK, it seems like an unsustainable situation with such a large state. And I'm afraid that neither the incumbent government or the next government, should it be a Labour government, will actually do anything about it to reduce the size of the state. So that's my biggest concern for next year, is the working population. And we're basically a massive big state of people who can't be bothered, and a massive NHS bill. And that's the reality of it. It's not a very popular thing to say, but that is the reality.
It is. I don't want to veer off topic. I know we've got other things to get onto, but is the UK actually unique in that respect? You know, you look at America, federal spending is going through the roof. You know, even under the Trump administration, federal spending carried on moving higher. It's done so again under Biden. It'll probably do so again under the next administration. You know, are we now just in an environment where government spending is always going to be going higher because no politician, for whatever reason, wants to bite the bullet and say, actually, we can't afford that. We need to tighten our belts?
I think that runs a very real risk. And again, if you actually go back to the election results, Boris, whatever you think of him, he squandered a massive opportunity of having such a dramatic imbalance in his favour to drive through unpopular policies like that. He decided to sit on his arse and not bother, which was a real missed opportunity, in my opinion. But to your point, Mike, I'm personally biding the time until one central bank, and I don't know which one it's going to be, to blink first, but I think somebody has to increase the target that's acceptable. 2% is prudent. Not anymore. It's a very, very difficult number to get back to. And like you say, the closer the different economies get to it, the harder it's actually going to be. You know, again, saw projections earlier this morning that actually 2025 is more likely the due date for us to be anywhere near it, which suggests that, you know, we've got another 2 years ahead of us potentially of above target inflation. Now, who in the government is going to complain about that when it's all helping inflate away the mountain of debt? But that's the point. Sooner or later, somebody is going to bite the bullet, one would expect, and go, yeah, do you know what? That doesn't work mathematically. The imbalance isn't going to be controlled by spending. So let's just accept a higher level of inflation and see if we can control it.
Well, it's a popular theme that is gaining prevalence, isn't it? The idea of raising the target rate. Is there a recency bias to this? Is it we've seen the pain of the last 2 years, and are we forgetting the years prior? Mike, what do you think? Are you a student of the inflation rate? I expect.
Well, the first thing I was going to say is that there isn't, well, there is now, but there was never actually anything, you know, scientific about 2%. I think it was New Zealand. Someone from the RBNZ was asked what inflation rate do you target in a TV interview, and basically just went 2%. And then after that, everyone's done a load of research to effectively prove why that's the number that you should go for. I think the issue is, and I agree, I think you are probably going to move to a world where central banks do change their inflation targets. I think the issue is you can't do that until you've got inflation back to what the target is at the moment, because otherwise you just erode all of your credibility, and essentially you're giving up. You know, you're admitting defeat, saying we can't get back to 2, so we're going to change it to 3 and say that we've done our job. I think you need to get to 2, arguably get below 2, and then you can have the conversation around doing something like the Reserve Bank of Australia do, for example, where they say we want it in a 1 to 3% range. And that will just shift inflation expectations marginally higher. But I think you need to wait until you've achieved the current target before anyone starts to even think about tinkering with it.
And it's
but I think if you're going to get sorry, Harry.
I was going to say it's a credibility play, and I did just frantically look up the long-term average, and it's about 3%. So it makes sense what you say, Paul. Yeah.
But equally, I think, you know, I take your point, Mike, whereby when it was raised earlier in this cycle with inflation, you know, up in double digits of, maybe we need to recalibrate what the base level target looks like. Everyone was like, yeah, rewrite the rules, mate, because it's a difficult challenge you've got to do now. But why don't you actually just go and do your job and get it down to 2%? How about that?
Yeah.
But arguably, you know, that thought process needs to experience maybe a recession. Again, the recency bias hasn't felt that kind of pain in order to get it back to 2%, maybe down further beyond 2%, in order to then adopt or accept the point of view of that, yeah, maybe beyond 2% is the right number now. But yeah, again, who knows what the right play is? But if they had been more aggressive earlier in the process and had caused a recession, maybe that would now be part of the open conversation rather than a complete hypothetical.
So some bloodletting maybe, and it seems to me, just to close off this point, without opening the box on the causes of this particular inflation, it was multifaceted, and I think it was both on the supply and the demand side, as we had ship workers, dock workers with COVID couldn't get on boats. We had boats stuck in the Suez Canal. We had people stuck at home buying things off Amazon, couldn't get them delivered. We had imported inflation through energy. We had a war. We had all this stuff going on that contributed on both sides of the equation to prices going up. And I think it's just been particularly sticky. And I think maybe in 20, 30 years, we'll look back and it will stand out as a really unique time. But 3 quick questions for you both, because we're coming towards the close-ish. So let's start with you, Mike. So 3 questions for you. 1, is Europe heading for a recession? 2, will the US have a soft landing? And 3, who's going to cut rates first of the G10 central banks and why?
Okay, is Europe heading for a recession? Yes, but if I was to be really picky with you, I'd say it's probably already in one. You look at the PMIs, particularly Germany. If Germany is the supposed growth engine of Europe, well, the engine has stalled and might even have fallen apart at this point. And you've also got risks firmly tilted to the downside in Europe, given what's going on in China at the moment. So yes is the answer to the first question. Is the US economy heading for a soft landing? Yes, I think it is. I think the jobs numbers that we got last week were very, very promising. Unemployment coming back to 3.7, even as participation rose, and 200K on the payrolls number. Even when you take out auto workers, it's 170. So yeah, I think the US is going to make that soft landing stick. But I would caveat that by saying I don't think the Fed will cut until inflation is back at 2%, which will be later than the market expects. And I guess that leads nicely on to the last point, which is who cuts first. Up until about 6 weeks ago, if you asked me this question, I would have said the Reserve Bank of New Zealand. And the reason I say that is because they were the first to end their hiking cycle. And you're already seeing the jobs market soften, growth begin to roll over. There's been a couple of weather-related events down there as well. But I think actually now there is a really strong case that the European Central Bank, the ECB, could end up cutting as soon as they're meeting next March. Inflation will probably be back at 2% at that point. And if the bloc is in recession, then what is there that the hawks can use in that governing council meeting to say we shouldn't be cutting rates? So right now, gun to my head, I'd say the ECB probably late Q1, early Q2 next year.
Solid answers. FX Blue, where are you on those 3?
So similar with the recession, yes, I think everything's driven by Germany on the continent, and they're really struggling at the moment. So I think that the outlook is pretty bleak for them there. Yes, I do think the US will navigate a soft landing. Yeah, I think there's enough headroom in all of the data points to allow for that. And in terms of who will cut first, I think there's an outside chance the UK will surprise us. I don't know what kind of timeframes. Again, like maybe the ECB if they're going in Q1, but I think maybe early Q2 we'll see something from the UK. So if we can put the Europeans off by a couple of months, maybe the UK will have them.
We'll pip them. Okay. Well,
I'm not sure that's a race we want to win, is it?
Well, no. I mean, again,
maybe for your mortgage, but.
It'll be too late by then, sadly. But yeah, I think the growth element of the UK will put increasing pressure on, or the lack of growth rather, the stagnation will put increasing pressure on those to act. And in exactly the same way as we saw a real token rise in December 21. But hey, look at the accolades that we got for moving first. Maybe we'll cut by 0.1. Just see what happens.
See what happens. Well, we've got a rare consensus, gents. I think also that Europe is likely to have a mild recession. Maybe they're already in one. GDP has been plus or minus 0.1% all year. PMIs are miserable. Likewise, retail sales. Ireland is even in recession right now, right? Inflation seems under control, and therefore I think that the ECB, and I've been saying this since August, to skip to question 3, I think that they're likely to be the first to cut on the basis that why would they hold if inflation is back within their target? Skipping back to question 2, yes, I think the US will have a soft landing, especially if we look at the jobs market. The inflation rate continues to fall. And the growth rate at 5-point-something% last time out, unbelievable. Great year for stocks too, as you mentioned at the start of the call, despite a poor October. So a consensus indeed. And very quickly to move on to our forecasts, outlandish predictions for 2024. Now, I really had to think about this. I think that if there's an election in the US, I think Trump might win, but I don't want to go with that. The point of the outlandish prediction is something that might be a bit crazy. I think that we're going to witness the complete undoing and failure of Bitcoin as people realize it's based on a scam. We might see another imprisonment. The price will fall to zero, and Twitter will completely implode as everyone realizes they can no longer buy things with their Bitcoins. So that's my outlandish prediction.
Wow.
You say that as if someone can buy something with their Bitcoins now. I mean, I can't exactly go and get a coffee with one, can I?
Mike, what's your big call for next year? Your crazy call?
Well, I'm afraid it's nothing as crazy as outlandish as that. I didn't quite realize I had that much license to set the creative juices flowing. I think I've gone for actually outright deflation in developed markets. I think we've already seen signs of, well, China is in deflation at this point. Whether you call it a DM or an EM is up to you. The Eurozone is seeing inflation fade very, very rapidly indeed. Japan there's obviously a risk that they slip back into the decades of deflation that they've already seen. And if growth really does fall off a cliff in the rest of the Western world, then we could arguably see a similar scenario here. And many would argue, and I would be one, that actually deflation is worse for an economy than high inflation, because it's a lot harder to get a grip of and a lot harder to stimulate the economy out of that. And I guess the concern I have is that central banks are still scarred from what happened in 2021, where inflation's transitory, it's temporary, we're going to look through it, we can ignore it, it's all going to sort itself out, that they end up leaving rates too high for too long and policy stays too restrictive for too long because they don't want to make that mistake again, and they end up making a second policy mistake because of the first one, just on the other side of the coin.
Oh, it sounds miserable and grim. FX Plewman, what's your outlandish prediction for 2024?
So I have some of this. For somebody who's not political, I reckon the Tories will stay in power.
Okay. Do you want to add anything to that, or are we just dropping that?
Well, yeah, I mean, like I don't substantiate chat like that. I don't want to fan the flames of a political discussion any more than a religious one. But I think they will struggle to claw back the deficit in the polls, no question. That's why it's deliberately contrarian. But I fear that the idea of voting anybody else in, just because the incumbents are a bunch of shysters and have fucked everything. Sorry, have ruined everything over the past.
You've got a little bleep button we can use.
Yeah, sorry. Well, you started off politics. Here we go. Yeah, I don't think there's a good enough alternative, and that is absolutely not advocating their performance. But I think the political spectrum in Westminster at the moment is bleak. On either side of the aisle, there's very little inspiration, and so a little bit of financial tinkering in Hunt's spring budget, maybe in the autumn budget, maybe leaning on the impartial Bank of England to cut rates for the feel-good factor at some point earlier than perhaps they should do. A bit of political tinkering, and maybe in the heat of the ballot box, it's like, well, maybe we'll go again.
Go again, another 13 years. Well, we were going to do some currency predictions, but I think we all believe that they're all based on nonsense. And in fact, nobody's really capable of predicting a currency.
I have to put my crystal ball away.
Yeah, you put your crystal ball away. So we're just about there for time. Bitcoin's going to go to zero. We're going to see deflation and the Tories will stay in power, apparently, according to our crazy predictions. So that does bring us to a close. Thanks so much to Michael Brown and to FX Blue for joining today, and to everybody on the call. I really appreciate it. Hope you've enjoyed it. Hope it's been fun and interesting and you take something away from the conversation. You know, as we look back across the year that we've had, there's been an awful lot of talking points. Certainly, uncertainty is the big one. I think that's the present risk to business, and it is our job, all three of us, the companies that we work at, to help you to navigate and mitigate against the impact of those risks and uncertainties. So I wish you all good health, happiness, a very Merry Christmas, best of luck and good fortune for a prosperous 2024. Thanks, Mike. Thanks, FX Blue, and we'll see you in the new year. Cheers.
Thank you.
Thank you, mate. Goodbye.
Bye-bye.